Let me guess your position. You know what fair value gaps are. You know what liquidity is. You know what good price action looks like. And you know how to find your bias. But you just keep on losing trades. And you don't know how to fix it. Welcome to the second video of my series of completely uncut guides. In this guide, I'm going to show you exactly how to find the highest probability IFVG, AMD, PO3 setups catching, the biggest moves, the biggest R, with the most efficient price action on your team. All you need to do is get your notepad, your pen, make notes, come back to this video as many times as you need to. But as I said, this is the complete uncut guide to finding highest probability IFVG setups. All you need to do, as I said, is watch this video, and at the end of it, you will probably have no questions. You'll know exactly how to trade just like me, just like everyone else in the Fast Track private community. Now, without further ado, let's get straight into it. If I can just move my face cam slightly. Here we go. So now you can see the charts. As I said, this is a completely uncut guide. There is nothing, no edits, no fancy edits, no cuts, nothing. Me, you, and the charts. So let's get straight into it. Obviously, first things first, very quickly, we need to cover what fair value gaps are. They're very simple, 3 candles. You know how it goes. 3 candles, the direction of the fair value gap is decided based on the middle candle. So we have this fair value gap right here, which, let's say the middle candle is not orange, red, to show bearish. So we have a bearish fair value gap because the middle candle is bearish, okay? It's 3 candles, there's a displacement in this. There's usually an imbalance, and the wicks of these candles do not overlap. If there's a gap between the wicks, that is the fair value gap that we talk about. What you'd expect price to do in a bearish fair value gap is come up to here, either respect it, come up to here, either respect it and continue down, or disrespect it and continue up. The same goes for a bullish fair value gap, okay? So if we pretend that this is bullish and we just do this, if we pretend that this is a bullish fair value gap, bullish because of the middle candle, that's the only candle that matters based on direction. We have a gap between the wicks, just like this. We draw our fair value gap, price will come into it, respect it, or price will come into it and disrespect it, and then continue down. Simple as that, okay? So fair value gaps are imbalances in the market, which we want price to come back to and either go straight through or bounce back up off of, okay? That's pretty much it. That's all there is about fair value gaps. That's all you need to understand, okay? 2 types of fair value gaps. There's bullish fair value gaps, bearish fair value gaps. Now there's also something called IFVG. IFVG stands for inverse fair value gaps, okay? There's 2 types of those. There's bullish ones and bearish ones, okay? So with an IFVG, that's when a fair value gap is disrespected. How does a disrespected fair value gap work? What does a disrespected fair value gap look like? A disrespected fair value gap is simply when a candle closes behind it. So if we have a bullish fair value gap here, all we need is a bearish candle to close below it, just like this. Okay, then it's disrespected, then it's an IFVG. And if we have a bearish fair value gap, okay, we just simply do this. If we have a bearish fair value gap and a candle closes above it, we need, with a bearish fair value gap, we need a bullish candle to close above it. Okay. Let me just draw this out. We simply just need a bullish candle to close above it like this, and then it's disrespected. That's what an IFVG is. An IFVG is a disrespected fair value gap where a candle has closed outside of the fair value gap. Okay, this inverses the direction, so it flips the direction. This flips the direction that we want to trade the fair value gap in. So if a bullish fair value gap is disrespected, it becomes bearish, and vice versa. If a bearish fair value gap is disrespected, it becomes bullish, okay? That's all you need to understand about fair value gaps right now. And as we went over in one of the first videos, I think, liquidity is highs and lows. Every single high you see is liquidity. Every single low you see is liquidity. So even in this candle, this one candle here, this retracement, liquidity, liquidity here, liquidity here, liquidity at every single high and low you can see on this chart, okay? Right here, right here. You already know what that is. Pending orders, pending stop losses, etc., etc., etc. That's ERL and IRL, okay? ERL and IRL. Now that that's out the way, we can focus on the best possible setup. So we know what ARL and IRL is. We apply it on the daily bias. If you haven't seen the daily bias video, that's in the playlist that this video is in. Probably check out my channel, it'll be there, full uncut guide of daily bias. Watch it after this video. So all we need to understand today is AMD, okay? AMD, PO3, and combining those two things, or that thing with ARL and IRL, okay? So we know how to trade ARL and IRL. This is the issue here. We know how to trade ARL and IRL, but we don't know what price action to trade it on. AMD and Power of 3 allows us to find the type of price action we want to see in order to apply ARL and IRL. Because as I said, ARL and IRL, it's literally exactly how the market moves towards liquidity, towards fair value gaps. There is literally not a time where this will fail, okay? Not a time, unless there's a massive news release. You can check Asian session and see this concept playing out. But the thing is, we want to catch the biggest moves. We don't want to get stuck in a reversal. We don't want to get stuck in any stupid stuff. We want to catch a nice big move to the downside, okay? How do we do that? We find the right price action to trade, okay? So there's this kind of principle that I want you to stick by from now on, okay? And we're going to put it in big here. So if we put this down, we go, after a big move, this is very, very important. After a big move, we will probably just consolidate, okay? And then vice versa, after a consolidation, we will typically just have a big move, okay, after a manipulation. Now, before we get into AMD properly, I want to show you this concept. So let's just look at this, for example, okay? So, so we have a big move up, we consolidate, we have a big move up, and I guess we kind of have a big move down then, pause a little bit, have a big move up, and this is kind of like a consolidation. We pull back down, pull back up, and have a nice consolidation here. Sorry, that circle's too small. Have a nice consolidation here, and then we kind of, just consolidate here after a big move down, quick move down, consolidate, quick move up, okay? Now this is just literally the close of Friday on the 5-minute time frame. We can see it literally everywhere. We have a big move down, pause, big move down, consolidate, push up, consolidate, push down, consolidate, push up, consolidate, push up, consolidate, push down, consolidate. Literally every single big move follows a consolidation, and every single consolidation comes after a big move. Big move down, consolidate, big move down, consolidate, big move up, consolidate, big move down, consolidate, big move up to here, then we consolidate, push up again, consolidate, push down. We actually caught this exact move on stream yesterday. We caught this exact move down, actually. Then we consolidated, then we pushed up. We caught this exact move up here, then we pushed up. We actually held through this consolidation, but then we pushed down because this was a news release. Then we consolidated, then we pushed up, down, kind of consolidated again. So after a big move, as you can see, literally, this is just on Friday. Like, we can go back further and see it more. Like, we push all the way down here. We have a nice consolidation, push up, consolidate a little bit here too, push up, push down, consolidate, and just into this cycle again. After a big move, that you can backtest this if you don't believe me. After a big move, we will probably just consolidate. After a consolidation, we will typically have a big move. Therefore, we can know exactly when we're going to have a big move. If we know exactly when we're going to have a big move, what's the logic? What is the most logical thing to do if we know exactly when a big move is going to happen? We wait to see. We wait to try and catch the big move. So if we know when there's a big move, okay? If we know when there's going to be a big move, we simply just have to wait. Just have to wait for the big move to start, okay? And then we can catch a big move. If we know when there's going to be a big move, all we have to do is wait to see when it starts, and then we catch a big move. If we know when there's going to be a big move, we can catch what? We can catch every single big move in the markets, okay? Every single one. Now, I only really aim to catch one a day. To be honest, I'm quite happy with that. But you can catch every single one if you really, really want to, using this exact concept. Okay, now what this is simply just an extension of the AMD, and I'm pretty sure you know what AMD is, but if we just look at that very, very quickly, it's an accumulation, so a consolidation, okay? And this is built on liquidity, and you know what liquidity is, so I'm going to show you exactly how it integrates with this as well. But we look for that consolidation, we look for that manipulation, okay? And then we look for the distribution. That is AMD. AMD. What does it stand for? Accumulation, manipulation, distribution, okay? So we have the accumulation, okay? The manipulation and the distribution, okay? So what are we know what they look like, okay? So, you know, just describing this for anyone that's blind, we have an accumulation, which is a consolidation. We have a manipulation, which is a sharp move in one direction. Then we reverse and distribute and have a big move. Distribution is the big move, okay? So if we want to catch the big move, we basically just want to catch the distribution, which means we don't really care about trying to catch accumulation and manipulation. So we just want to catch the distribution move, okay? But what do these three phases, what are the properties of these three phases? So we have accumulation, sideways price action, okay? And this is how it integrates with liquidity. It's a consolidation, okay? But as you know, liquidity is generated at every single high and low. So if we have equal highs and equal lows, okay, that's a consolidation. What does that mean? It means there's a lot of liquidity on either side of a consolidation. And if we go onto the chart again, I'll show you what I mean. So accumulation is sideways price action or a consolidation where equal highs and equal lows. It means a lot of liquidity on either side of a consolidation, okay? So it accumulates liquidity, okay? And you can see it here, like you can literally see it everywhere. Like here in this example right here, we accumulate, we have a very nice accumulation. We then manipulate, push up, take out all this liquidity. Then we get the FVG, and then we have a nice big move down. We caught this on stream, then we caught this on stream as well. Or not on stream, but in the private group. And the same thing happened on GBP USD as well. If we go over to this is literally a trade we caught live. We had a nice accumulation, a consolidation, okay? We then pushed up and had a big move relative to the consolidation that we had, okay? So now if we go back to GBP JPY, this one. If we know when there's going to be a big move, we simply just have to wait for the big move to start. A big move will happen after a consolidation. The big move is called distribution. The consolidation is called accumulation. So basically, we just have to wait. We just have to wait for price to accumulate. And then that allows us to basically squeeze and move out the markets. We have to wait for price to accumulate. Then we can kind of start to, I don't know, what's a good word for this? We can start to anticipate, okay? We can start to anticipate a big move is about to occur. We can start to anticipate that a big move is about to occur. Accumulation is sideways price action where we generate liquidity. Manipulation is where we sweep this liquidity, okay? We sweep this liquidity and also trick traders into getting in trades brackets to generate the liquidity. So if we see, right, you know exactly how Forex works, how liquidity works. There's a big bank who wants to buy, a big bank wants to buy 800 lots here. Wants to buy 800 lots, but there's only 600 being sold, which means there's a deficit there of 200 lots, okay? We need to generate 200 lots worth of liquidity. How do we do that? If they want to buy 800 lots, right? If they want to buy 800 lots, that means there has to be 800 lots being sold. If there's only 600 lots being sold, they need to make 200 lots appear out of nowhere. In other words, they need to trick people into selling the market, okay? Or getting out of buy positions. Why getting out of buy positions? Because when you get in for a position, you have to then sell to get out of it. So when you buy 10 lots, you have to sell to get out. You have to sell 10 lots to get out of that trade. Okay, so when you buy 10 lots, you have to sell 10 lots to get out of that trade. So if you have to sell the same amount you buy or buy the same amount you sell if you're in a short position, they need to trick people into selling the markets, either by people entering sell positions or people getting out of buy positions, because then there's a lot of people selling. They're selling to get out their buys, and they're selling because they think price is going to go down, okay? Which means the banks then have enough liquidity to buy 800 lots. So think about this, right? Price is accumulating, then the big banks manipulate price in order to trick people into selling, which pushes the price down. And then there's then enough liquidity for them to buy 800 lots, which pushes the price up very, very nicely, okay? That's AMD, that's how it works, that's the liquidity behind it, okay? So the manipulation is where we sweep liquidity and trick traders into getting into trades. Then the distribution phase, which is what we want to catch. This is when the quote unquote big banks enter their positions, okay? That's when they enter their positions, pushing the price strongly in one direction, okay? And it's literally as simple as that. That's what AMD is, and that's how you want to catch the big moves. Now we know when there's going to be a big move. Now we can use that to know when there's going to be a big move. So when you see a consolidation, you can anticipate a big move is about to happen. Just like this, just like this, just like this, just like this. I can go on all day if I really, really want to. Just like this. Just like this right here. Had a quick move down. Not really a big move in my opinion, but it was after a very, very long move down, hence that. But what happened before the long move down? A consolidation. What happened before that consolidation? A big move. What happened before that big move? A consolidation. What happened before that consolidation? A big move. What happened before that big move? A consolidation. What happened before that consolidation? A big move down, which is this one right here. Then we retrace and consolidate. What happened before that big move down? A consolidation. What happened before the consolidation? A big move up. What happened before that big move up? A consolidation, a big move up, a consolidation, a big move up, a consolidation, a big move up, a big consolidation. After a big move down, after a consolidation, after a big move up, after a consolidation, after a big move down, after a consolidation, okay? Now I'm sure 50% of the people just watching just quit because I was going on and on and on, but I think my point is proven, okay? So, now we know when there will be a big move, okay? Therefore, we know when to trade. All we need to do now is simply find out how to trade properly. Okay? So, we know what to do. When you open the charts, step one, obviously find your bias. When you're on the time frame that you want to trade, you then look for a consolidation. Okay? And then all you have to do from there is wait for this to happen. So you wait for that consolidation, okay, which is generating liquidity, okay? Then you wait for price to sweep the liquidity. Boom, manipulation. And this is important. In the manipulation phase, in the M phase, okay, we want price to form a fair value gap, okay? We want price to form a fair value gap. So in this manipulation, you see, okay, we form a fair value gap. Okay, then all we want to do, as we went over in the first video, I think, we only want to trade IFVGs. Why do we only want to trade IFVGs? Because there's only the absolute. That's the only absolute rule. We know exactly when a fair value gap has been inversed. Whereas we don't know exactly when a fair value gap has been respected. Okay, no one knows until it happens. The only thing is, when we know a fair value gap has been disrespected, we can catch the big move. When we know a fair value gap has been respected, there's typically been a big move to show us it's been respected. So what we have to do here, in the M phase, we want price to form a fair value gap. We then want to disrespect the fair value gap, which means we then need to go towards the next liquidity using ERL and IRL, as I shown you at the start of this video, as I shown you in the first video. We then push down, take out that liquidity, and what you can do here is you can have a full TP, okay? You can have a full TP, so let's say we had a big move before the consolidation. You can put your take profit at all the liquidity zones. Let's say there's a retracement here, let's say there's a retracement here, and let's say there is that's the start of the move. So before that, what did you reckon we did? Probably consolidated. Okay, so this is what you want to see, and then you'd want to enter here when we inverse this fair value gap, take profit all the way down here, manage at this profit level, manage at this take profit level, manage at this take profit level, and have a full TP over here with your stop loss simply just above the high, above the manipulation, just like this. That's what you want to do. Let me show you an example on the chart. So this is how we want to trade, okay? This is how we want to trade. Let's go onto the charts. Let me just do this. Make sure you got all this down. Remove 151 drawings. Let me show you an example of a trade that I literally took on Friday, okay? On Friday. Let's just find out where it is. Okay, right here. This is literally a trade I took on Friday. Made me 3%, okay? 3.2% to be precise. So, what do we have? We have nice sideways price action like this, okay? We then have a quick manipulation to take out this liquidity here. And in that manipulation phase, we form a fair value gap, okay? We form a fair value gap right here, okay? We then want a candle to close below it, just like this, where we enter our trade and we target the start of the big move, which was down here. Actually, I think I had my take profits all the way down here, to be honest. So we had our take profit all the way down here. We literally were going for like a 3.5, 4 hour trade. We entered there, simple as that, okay? Simple as that. Although I think, yes, okay. We entered around about here, simple as that. We had a nice accumulation, nice manipulation, and we're trying to catch the big move. How do we know there's going to be a big move? Because we just had a consolidation, and then we just had a manipulation to generate enough liquidity to fuel the big bank's position. Okay, so we enter our position right here. We then want to target this area. We manage at this level, we manage at this level, and we manage at this level here with a full take profit over here. So we go boom, take out this low. I'm like, okay, my stop loss is here now. We take out this level, and I close the trade because we bounced up straight off of it. And that's because of the high time frame context, because we bounced into a 1 hour fair value gap, if you can see that right there. 1 hour fair value gap, we bounced into that and bounced up off of it. So I closed my trade around about here, and it's literally as simple as that. That's all you need to do. That is literally all you need to do. We won. We took 4 trades yesterday on Friday. 3 of them were wins. And one was a very, very, very small loss. We lost 0.03%, less than a tenth, less than half of a tenth of a percent, okay? So it's like 3% of 1%. But anyway, that is how you want to trade. I've just shown you there, step by step. That is it. Go and back test this, get like a year back testing, and you will master this strategy, I promise. That's everything. Okay, that's all I've got to share with you right now. Make sure you're looking out for the next video. Make sure you're looking out for my next free trading stream where I trade this concept live every single day for free, as well as doing daily market outlooks every single day for free. All you need to do is click the link in the description, subscribe if you're new, like, comment, share, all that stuff. Click the first link in the description. It'll take you to my free trading streams. Second link in the description takes you to my trading course where you can learn every single thing about this strategy. Other than that, I've got nothing else to share. Thank you for your time. Have a good rest of your day. Have a good weekend. And that's it from me. Peace.